Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into SentinelOne Inc., a company that has spent the last decade fundamentally redefining what it means to secure modern digital infrastructure.
We really have to start this deep dive by framing, the central conflict. It's a story of real contrast for anyone looking at this stock.
Okay, so what's the core thesis?
Right. So SentinelOne is poised for an earnings-driven re-rating. The bet is that its AI-native platform hitting that huge milestone of $1 billion in ARR and achieving a positive non-GAAP operating margin will finally close that. That big valuation discount it has against peers like CrowdStrike.
And what's that discount looking like right now?
It's about a 6x forward price-to-sales discount. It's significant.
But this bullish outlook, it exists despite some pretty serious anchors, right?
It does, and those anchors are the persistent GAAP losses and, maybe more importantly, the high stock-based compensation or SBC dilution.
So that thesis, it instantly draws a line in the sand. On one side, you've got this incredible tech and clear financial maturation.
And on the other, you have these structural financial liabilities that are, they're enormous. You just can't ignore them.
So our mission today is to really unpack that complexity. We need to unravel the true strength of that technical moat against those really serious financial risks and figure out if SentinelOne is, truly ready to command that premium valuation its execution seems to demand.
It's the classic growth investment challenge, isn't it? When does the tech leadership finally translate into sustainable bottom-line accountability? And will the market reward that shift before the cost of dilution and those huge liabilities just overwhelms the gains? It's a real tightrope walk.
Let's start with the numbers then, because the financial story here hasn't just shifted. It's had a dramatic inflection. For any high-growth security company, that billion-dollar ARR mark it's more than just a number. It's a psychological barrier.
And they hit it. In Q2 of fiscal year 26. It was a huge validating moment, really confirming their trajectory from, a disruptive startup to a real enterprise-grade powerhouse.
So what were the exact numbers on that?
Total annual recurring revenue, or ARR, grew a really solid 24% year over year. It crossed the line at $1.001 billion.
Hitting that level, it sends a message to the market.
It absolutely does. It validates not just their initial product market fit, but the whole long-term scalability of their platform strategy. It tells everyone, look, we are here and we are playing with the largest incumbents.
And what gives that billion-dollar number real quality is how they got there. When you look at where the growth is coming from, management was pretty clear about it.
Yeah, they said the expansion motion is incredibly strong. They noted an even split between new logos and expansion with existing customers.
That 50-50 mix is so important.
It's critical for two big reasons. First, it proves they're still highly competitive, that they can still go out and land new, often very large deals.
And the second reason?
The second, and you could argue it's even more important for the long-term valuation, is that expansion piece. It proves the platform strategy is working. It shows the stickiness.
So existing customers aren't just renewing, they're buying more.
Exactly. They're not just renewing their initial endpoint licenses, they are rapidly adopting the other modules, cloud security, SIEM, identity, and that drives up average revenue per user, ARPU, and it really reduces your churn risk.
The strength of their momentum is probably best seen in the raw new bookings. This is where you can really quantify market demand.
Right. SentinelOne recorded $53 million in net new ARR in Q2. And that figure didn't just meet expectations.
It blew them away.
It significantly exceeded them. We're talking about a level of outperformance that really suggests a genuine shift in the competitive dynamic.
And was this driven by a few big deals, or was it broader?
Management said it was a broad-based outperformance, so not just one or two mega deals, but consistent demand across different geographies and customer sizes. They estimated it was about a 40% upside to their original guidance for the quarter.
40%. That is a massive surprise beat. In this kind of environment where you hear about rivals having longer sales cycles, macro uncertainty, a beat like that points to a product that's really differentiated.
It suggests that when a CSO is making a decision right now, they're not just comparing prices, they're looking for the absolute best autonomous solution to solve a really acute pain point.
And that leads us down the income statement to the quality of that revenue. The operational inflection point is just undeniable here.
Yeah, you look at the margins, and the quality of their subscription revenue is exceptional. They posted strong gross margins, hitting 75% GAAP and a really phenomenal 79% non-GAAP in Q1 of fiscal 26.
That 79% non-GAAP gross margin is elite territory. It shows really efficient software delivery pricing power. But the real shift, the promised maturation, is in the operational profitability.
This is it. This is the moment. Management has explicitly reaffirmed its commitment to achieving full-year operating profitability on a non-GAAP basis, and crucially, delivering positive free cash flow, or FCF, for the full fiscal year 2026.
So they're moving from a pure growth story to a growth at scale story.
That's the transformation. And to show you how fast they're moving up that leverage curve, FCF generation actually hit a record 20% margin in Q1. Now, once you hit FCF positivity, that gives you a self-funding mechanism for growth. It gives them massive financial flexibility.
And that flexibility is backed by a pretty bulletproof balance sheet, right?
Oh, yeah. $1.2 billion in cash and investments, and importantly, no debt as of April 30, 2025. This kind of liquidity lets them bypass volatile capital markets for funding. They can self-finance strategic M&A.
They even started a share buyback program.
Exactly. A $200 million share repurchase program, which they were able to initiate because of this FCF strength.
So looking ahead, what's the full year projection for operating margin?
The projection for full-year fiscal 26 non-GAAP operating margin is set at about 3%. Now, that number itself might sound a little modest.
But it's the improvement that matters.
It's the improvement. It represents an impressive 600 basis point improvement over fiscal 25. And that's driven by better cloud efficiency, slower growth in R&D relative to revenue, and just disciplined hiring. They're really starting to realize that operational leverage.
The old narrative was always high top-line growth, but with big bottom-line losses. Now it seems like OpEx growth is lagging revenue growth, signaling that maturity phase you see in successful SaaS companies.
And the market has noticed. It's noticed the shift from just capturing market share to actually realizing margin. But what's fascinating is that the market is willing to credit them for the FCF shift, but it's still applying that huge 6x in valuation discount.
Which means those underlying financial risks, the GAAP losses, the SBC, are still weighing very heavily on investor sentiment.
Exactly.
Which brings us to their core defense. In cybersecurity, the financial story only holds up if the tech is truly differentiated. So let's dive into that core AI architecture. What are they doing differently that gives them a real moat against giants like Palo Alto Networks or CrowdStrike?
The difference is really architectural, and it's temporal. SentinelOne was designed to be AI native from the ground up. We're talking back in 2013, before AI was just a marketing buzzword.
So they weren't bolting it on later?
Not at all. Legacy solutions were built on signature databases, basically a blacklist of known threats. Even some modern competitors, they primarily rely on cloud-based analytics.
Which means if you lose connectivity, your protection gets worse.
It degrades, exactly. SentinelOne fights this with what they call distributed AI models.
Distributed. That sounds like the key advantage. Explain what that means, where these models actually live.
So they use these sophisticated static and behavioral AI models that run directly on the endpoints, your laptop, a server, a cloud workload. These local models are continuously trained so they can analyze and predict malicious actions autonomously.
And that's critical because it means it works, even if the device is offline.
Precisely. An employee on a plane with no Wi-Fi, a server that's been segmented from the network during an attack, it still works. That ability to function in an air-gapped state provides a layer of resilience that these cloud-dependent models just can't match.
And that local capability then feeds into their big proprietary feature for incident response, which they call storylines.
Right. And a storyline isn't just another alert. It's a complete narrative reconstruction of an attack. The platform is correlating petabytes of data from endpoint logs, network traffic, identity signals, all in real time to dynamically build context.
So it's tracking the entire life cycle of a threat.
The entire thing. They call it attack vector agnostic detection. So instead of an analyst seeing, 1,000 scattered unrelated log entries, they have to spend hours trying to piece together manually.
The platform just hands them one single comprehensive story of the attack. Here's how it started, here's where it moved, here's what it was trying to do.
Exactly. And that contextual awareness is what enables their most compelling and I think unique capability. The ability to turn back time on a device with a one-click rollback.
An undo button for a hack.
Pretty much. Because the storyline has mapped out every single malicious action, the system can just autonomously reverse all those changes. It restores files, registry settings, system configs, all back to their pre-attack state. It's the ultimate safety net.
That one-click undo button has to be a profound value proposition. It changes the entire economics of a security operations center, or SOC.
It does. It shifts it from expensive manual cleanup to automated recovery. They're not just selling detection, they're selling guaranteed remediation.
Yeah.
The economic impact is massive because manual cleanup is slow, complex, and requires your most highly paid people.
Okay, let's talk about architectural resilience. This has become a huge topic in the industry after some high-profile outages at competitors. You mentioned their minimal reliance on deep kernel-level integration.
Right. Management sees this as fundamental to system stability. For anyone who's not familiar, the operating system kernel is the absolute core of a computer. Historically, security tools needed deep access there.
That's risky.
It's inherently intrusive, it's complex, and it's prone to causing system disruptions, the infamous blue screen of death, especially when the operating system gets a critical update.
So the traditional solution is like wearing a heavy vest inside the computer's engine room, and every time the engine gets upgraded, the whole thing might seize up.
That's a perfect analogy. SentinelOne avoids the kernel entirely on Mac OS and Linux and minimizes its reliance elsewhere. They use other methods like lightweight sensors and user space hooks to get the same visibility without the instability.
And the market is waking up to this risk.
It's become acutely aware, especially after competitors had major outages last year. We've even seen Microsoft actively developing programs to help security vendors move away from kernel drivers and towards these user space solutions.
So that's some serious retrospective validation from a major platform vendor.
It is. It tells every risk-averse security engineer out there that SentinelOne's platform is structurally safer and more reliable for the long haul.
We've established the technical superiority, but how does this actually translate into hard numbers? Let's look at the gold standard of external validation, the IRE, ATT, and CK evaluations.
The data here is, it's just irrefutable and it's consistent. SentinelOne achieved 100% detection in the MITRE evaluations for the 5th consecutive year, and crucially, with 0 detection delays.
That kind of consistent performance is incredible. But as you said earlier, detection is only half the battle. The real value is in the signal-to-noise ratio. Getting 100% detection doesn't help if you just bury your analysts in junk alerts.
And this is where that autonomous capability provides a staggering advantage. Because the platform correlates and auto-remediates, it filters out the noise so dramatically. SentinelOne's solution results in 88% fewer alerts compared to the median competitor in the MITRE evaluation.
88% fewer alerts. That's not a small number. That translates directly into human productivity and operational sanity.
It does. So many cybersecurity analysts suffer from alert fatigue. The sheer volume of notifications forces them to ignore crucial warnings. By cutting the alert count by almost 90%, SentinelOne gives them a dramatically better signal-to-noise ratio. Analysts can focus on the handful of things that truly need a human. It's a core competitive advantage.
Okay, so a measurably better and more resilient mousetrap. Let's pivot now from the core platform to the growth engines. How are they turning this technical edge into revenue acceleration? Purple AI seems like the perfect place to start.
Purple AI is a phenomenal proof point. It's their generative AI assistant for security teams, and it has been an absolute revenue home run. It gives them a clear, revenue-generating AI story to tell.
And how fast is the adoption?
It hit record momentum in Q2. We're talking triple-digit bookings growth in the year since its general availability, but the attach rate is probably the most surprising metric of all.
Go on.
The attach rate for Purple AI surpassed 30% of licenses sold during the quarter. That is the highest level they have ever reported.
A 30% attach rate for a new module in its first year. That's incredibly fast by industry standards. It signals that customers are seeing immediate, undeniable value.
Absolutely, and the stickiness comes from its benefits. Purple AI lets analysts ask complex questions in natural language, and the AI queries petabytes of data instantly. It synthesizes threat intelligence, empowers analysts of all skill levels. It's like a super intelligent co-pilot.
And there's a real ROI there.
A huge one. Internal studies show up to a 338% 3-year ROI for customers just by cutting down the time they spend investigating incidents.
That adoption points directly to their successful transition from being just an endpoint security company to a full platform provider.
And that platformization isn't a goal anymore, it's a reality. The bookings mix confirms it. Non-endpoint solutions, so everything but their core endpoint protection, contributed over 50% of quarterly bookings in Q2.
50% outside of endpoint is a critical milestone. What specific solutions are driving that expansion?
Data and AI solutions are the fastest growing areas. That includes their AI SIME offering, which, by the way, surpassed $100 million in ARR back in Q1. And the land and expand metrics are just incredible.
What are those numbers?
Over the past 2 years, they've seen a tripling of customers with 3 or more solutions and a quadrupling of customers with 4 or more solutions.
Tripling and quadrupling in 2 years.
Yeah.
That's the land and expand motion in overdrive? They are dramatically increasing the value they extract from every single customer.
And while they're excelling in the enterprise, we shouldn't forget that their core endpoint product is still extremely strong in the mid-market. This is a segment where competitors often struggle.
Why do they do so well in the mid-market?
Their core positioning is super simple and plug and play. Mid-market companies have smaller, less specialized security teams. They don't want a platform that needs expensive professional services or massive training just to get it running.
Right, they need something that just works.
Exactly. SentinelOne's high degree of automation means they see less competition in this segment compared to larger vendors whose platforms often attach mandatory managed services, which just isn't a good fit for a simpler operation.
Okay, let's move from organic growth to strategic M&A. They've been busy on this front. Let's start with Observo AI. What role does this acquisition play?
The Observo AI acquisition is all about solving the data gravity problem, especially for SIMEs. SentinelOne rightly sees that security data often gets trapped in rigid pipelines, and it's burdened by high storage and ingestion costs in those legacy SIME models.
And if your data is trapped, you can't analyze it efficiently. You can't automate the SOC.
Precisely. Observo introduces an AI-native data architecture that's open, intelligent, and optimized for what they call the autonomous SOC. It allows for fast, seamless data routing. For example, it's expected to cut down complex SIME migration time from months to just weeks. It removes a huge piece of friction for customers.
And then, shortly after, they made a big move into securing generative AI with the acquisition of Prompt Security. This feels like staking a claim on the next major frontier.
It is. The Prompt Security deal, valued at around $180 million in cash and stock, is expected to close in Q3. Its purpose is to secure Gen AI usage in the workplace, preventing a critical new vector of risk like prompt injection and data leakage.
What does Gen AI security mean in practice?
It means controlling how employees interact with large language models, whether it's public ones like ChatGPT or internal company models. Prompt Security gives you instant visibility and control over that usage.
So you can see what data is being put into prompts.
Exactly. And crucially, it allows SentinelOne to jump right into the highly valuable data loss prevention, or DLP space, directly from the endpoint without needing any additional agents or dependencies.
DLP is huge. That's a multi-billion-dollar market. So this $180 million deal is basically a license to play in a massive new market.
It's a strategic imperative. The financial impact is minimal on the top line for this year, fiscal 26, but management did estimate an 80 basis point impact to the full-year operating margin because of integration costs.
And that's a critical question. Are they overpaying for these strategic assets, accepting a margin hit today for future potential?
That's the tension. If Prompt Security only offers minimal immediate revenue, then $180 million and an 80 basis point margin hit is a steep price. It means they see securing Gen AI as an urgent, defining threat that they have to own now, even if it pushes out their GAAP profitability timeline.
They're prioritizing capturing that next wave of security spending.
Right. DLP, Gen AI defense, SIEM transformation. These are all high-growth markets, even if it temporarily slows the pace of margin expansion compared to just running a highly profitable endpoint business.
Moving beyond M&A, what about other market penetration catalysts? What's opening up for them?
The big one is the massive U.S. federal sector. The company just achieved FedRAMP High authorization for both its Singularity platform and its data lake solutions.
FedRAMP High. That's the gold standard for government security clearance. Why is that specific level so important?
It's mandatory for dealing with any sensitive, unclassified government data. This authorization unlocks all public sector entities, the federal government, state governments that follow those guidelines, that are subject to strict compliance mandates like NIST SP 853.
So without this certification, that entire market is just closed off to them.
Completely closed. With it, the federal government becomes a key long-term growth catalyst. We're talking incredibly large, sticky, and often mandated contracts.
Okay, so SentinelOne has checked all the boxes. They're technically superior, they're financially inflecting, they're platformizing rapidly, and they're unlocking huge new markets. This brings us to the final verdict. Does all this positive momentum outweigh the structural liabilities?
The investment case for a powerful re-rating is, I think, structurally sound. You've got the AI native differentiation validated by Worry, the kernel resilience, that revolutionary storyline tech, and it's meeting a clear, undeniable financial inflection.
Crossing $1 billion in ARR, accelerating net new ARR, and a clear path to FCF profitability.
Exactly. And the platform adoption metrics are the proof. Over 50% of bookings from non-endpoint solutions, that light and fast 30+% purple AI attach rate, it all suggests they have a sticky, scalable platform that's rapidly increasing ARPU. This success should, theoretically, justify narrowing that 6x valuation gap.
But as our thesis stated from the top, this bullish outlook persists only despite the serious financial anchors. Let's spend some real time on these structural risks, because they are not trivial. Let's start with the persistent GAAP losses.
This is the #1 reason for that valuation discount. While management is touting non-GAAP profitability, the historical and present cost of operations under generally accepted accounting principles is substantial. For fiscal 2025 alone, the net loss was $288.4 million.
And when you look at the cumulative effect of all that spending, all the R&D and sales, the balance sheet shows an accumulated deficit that hit a staggering $1.9 billion as of July 34, 2025.
That accumulated deficit is a profound historical drag on shareholder value. Even if they're FCF positive now, investors are constantly reminded that this business has historically just consumed an enormous amount of capital. And that focus on non-GAAP profit, it obscures the real GAAP cost of growth.
Which leads us directly to the second major structural risk, stock-based compensation. SBC dilution is the elephant in the room for every high-growth security company.
It absolutely is. This is what separates their non-GAAP success from their GAAP losses. While their cash flow has turned positive, high SBC remains a massive non-cash drag on GAAP earnings, and critically, it causes shareholder dilution.
How much are we talking about?
For Q2 of fiscal 26, the SBC expense was substantial, $73.884 million.
$73 million in a single quarter. To put that in perspective, their reported GAAP operating loss in Q2 was about $80.6 million. So that SBC expense is basically the entire reason they're not at GAAP operating profitability.
Yeah. It is. It shows you how much of that non-GAAP operating margin improvement is really just backing out these equity expenses. Now, management will argue, and it's a fair point, that this high SBC is necessary to attract and retain the world's best AI and cybersecurity talent.
Especially in places like Israel and Silicon Valley.
Right, you have to pay market rates, and that often means a lot of equity. But the reality for the shareholder is that they are paying for that growth through the persistent dilution of their ownership stake.
And this is a key difference from a peer like CrowdStrike, which has better GAAP metrics and better managed SBC as a percentage of revenue.
And that difference is a major reason why the market applies that 6x valuation discount.
Right.
If SentinelOne wants to close that gap, they have to show a credible, accelerating path to GAAP profitability. That means either cutting back SBC, which is hard, or growing revenue so fast that SBC just shrinks as a percentage of the total.
Finally, we have to analyze a unique and potentially massive financial risk tied to their international tax structure, the APA tax liability.
This is a complex but highly material risk. It comes from ongoing bilateral advanced pricing agreement, or APA, negotiations with U.S. and Israeli tax authorities. The core issue is transfer pricing.
Can you break down transfer pricing for us?
Sure. In short, big international companies have lots of subsidiaries. Transfer pricing sets the price at which one subsidiary sells goods, services, or in this case, intellectual property rights, to another subsidiary in a different country. Tax authorities scrutinize these prices to make sure profits aren't being unfairly shifted to lower tax countries.
And since a lot of SentinelOne's core AI tech was developed in Israel,
the Israeli tax authority claims a substantial amount of profit should be attributed there. And as a direct result of these negotiations, the company had to record an uncertain tax position, resulting in a tax expense of $136.0 million in the first 6 months of fiscal 26.
$136 million. That's an enormous provision. That's a tangible acknowledgement of a very real liability.
It is. It signifies a substantial financial risk depending on the final settlement. If they reach an agreement, it provides long-term certainty, which is a positive, but it could require them to make big payments. If they fail to agree, Israel could initiate an audit, which would lead to even more uncertainty and penalties. This $136 million is management's best guess at the cost to resolve this.
So we have this remarkable duality. On one hand, you have a superior AI-native architecture, proven platform dominance, and a crystal clear path to FCF profitability. The technology story is absolutely winning.
And on the other hand, the financial scrutiny reveals massive accumulated GAAP losses, constant shareholder dilution through necessary SBC, and a nine-figure tax liability hanging over the balance sheet. It's a true study in contrasting risk and reward.
It makes SentinelOne a fundamentally asymmetrical investment bet. The question for every investor is whether that structural tech edge and the undeniable proof of operational leverage will compel the market to re-rate them, overcoming the immediate financial skepticism. Their main peer, CrowdStrike, trades at a multiple 6x higher on a forward PS basis despite similar gross margins.
And a large part of that is because the market sees them as being closer to GAAP maturity. Therefore, the final provocative thought for you, the listener, is this. SentinelOne's successful execution hinges entirely on whether the market will begin valuing architectural innovation and demonstrable platform expansion over immediate GAAP profitability, making us an asymmetric bet on whether they can force that valuation gap to close through sheer relentless execution against larger rivals.
Risk defined, portfolio protected.